The market's been very volatile since early January, and when this happens, unique opportunities open up for professional options traders that other traders might miss. I'm Seth Freuberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the traders on our proprietary trading desk implement what we call playbook trades to leverage the opportunities that emerge when the market gets very volatile. So if you'd like to learn a simple trade that professional options traders would easily be able to spot but may not be as visible to other kinds of traders, then stick around because I think you'll be surprised how robust this trade is. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really valuable. Okay, so the market's been on a pretty rocky ride so far this year, with SPY stock, which basically represents the large cap stock universe, down very close to 20% off of its highs of 2021 at one point. And so when you get a sell-off that deep, there's a corresponding phenomenon which takes place, and that is that the options market starts pricing in large movements in stock prices, both up and down, and as a result, that has the effect of causing those options prices to rise pretty much across the board. And the way that this is typically measured is through an index called the VIX index, which measures how much stock price volatility the options market is predicting going forward. And as you can see, the VIX over the last year, when fear was at its lowest level, would bottom out at around 15 when fear was at its lowest levels. But since the first of the year, it has spiked up a number of times over the 35 level, demonstrating very high levels of fear. Although you'll notice that it usually doesn't stay there for long, meaning that fear kind of peaks out and then recedes, which is actually a predictable pattern if you're a student of the VIX like we are. Before we get into how these VIX spikes constitute a really big opportunity, if you know a little something about options trading, I wanted to let you know that if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on its direction, then click the link that should be appearing now at the top right corner of your screen. That's going to open up the free workshop registration page in a new window. So don't worry, you won't lose this video, or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this. So pause this video, sign up now, and then resume watching. Okay, so now in order to teach you how this option strategy works, we need to do a really quick review of how options on stocks work so that everyone watching this video understands how they can be used to trade. Now, if you already know how they work, just please hang in there. This is going to be quick, and then we'll jump right back into the lesson. Okay, so what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below market, which makes the call very valuable in that situation, obviously. Or conversely, as to the put option, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put which again makes that put option very valuable in that case. On the other hand, if on expiration day the stock closes below the strike price of a call, unless it was previously exercised, the call expires worthless and the call seller just pockets the premium. Similarly, if you sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it expires worthless and the put seller just pockets the premium. Okay, so now keeping that in mind, let's head back to February 21st of this year. And as you can see, on that day, the SPY traded at one point during the day at 420, which is almost exactly 12.5% below its highs for the year. And so some traders might have very logical seen that as an opportunity to buy what has now turned into more than a market correction and get into the market at a price substantially below its all-time highs. And so suppose that you bought 400 shares of SPY that day for 420. Now let's move forward a few weeks later to March 7th. And as you can see, the VIX had spiked that day over 35 for only the fourth time this year. And so options traders understand this to be a unique opportunity. And to explain just why, let's head back to May 28th of 2021, about 10 months earlier, when the SPY was also trading at 420, which at that time was very near its all-time highs. Now, let's take a look at the VIX on that day. And as you can see, fear was actually really low, with the VIX trading down at 16.76, which is a very modest VIX reading and indicates very little fear of market volatility at all, which makes sense because the market is now pushing up to its all-time high with no real signs of a let-up, with every dip getting bought. And so the options market is not pricing in much stock price volatility at all. So staying in May of last year, let's pull up an options chain, which at that time would have been a little bit more than a year away from that point, a year into the future, an options chain expiring in June of 2022. And let's head up to the 490 call option strike price, which is about 70 points higher than where the stock is trading now. And we'll sell 4 of those 490 calls and then head down to the 360 put option strike price and sell 4 of those. And then for reasons we'll explain a little bit later, we go down another 100 points and buy 4 of those 260 puts. Now, in a little bit, we're going to explain to you how all of this applies to the SPY options trade we could have made more recently. But before we do that, let's take a look at the cash flow of the trade that we just modeled for you way back in May of 2021. And as you can see, we start out with those 4 calls we sold for the market price of $4.01. But remember, each call option represents the right to buy 100 shares of a stock. So you multiply that price by 100 and you sold 4 of them, resulting in positive cash flow of $16.04. We also bring in $6,144 for selling those 360 puts, as you can see from the calculation. And additionally, we pay out $1,572 to buy those 260 puts for a grand total net cash flow, positive cash flow of $6,176. Now remember, that was all done in a low volatility environment at the exact same price that SPY was trading on March 7th, 2022, when the VIX was over 35, as you'll remember. And don't forget, we had bought those 400 shares of SPY a few weeks earlier. And so if we do the exact same thing that we modeled for you in May of 2021, selling 4 of the 490 calls, selling 4 of the 360 puts, buying 4 of the 260 puts, just like we did earlier in May of 2021 with the stock at basically the exact same price and using all of the same options. And with an options chain about a year out from expiration, in other words, this is all apples for apples, then as you can see, the prices are quite a bit higher than before. And if we break that down, you can see that we received $41.80 for the forward 90 calls and $86.64 for the 360 call puts, paying out $2,652 for the 260 puts, for a total this time of over $10,000 of positive cash flow, while the May 2021 trade brought in a little over $6,000, a 65% increase for the exact same trade, with the only difference being that one of the trades was made in a low volatility period and the other one was made in a high volatility period. Now, you may be wondering, why exactly did we set this trade up this way, selling the call so far above the market price, selling the puts so far below the market price, And why the heck did we buy those 4 puts at 260, way below the market? And there actually is a very logical reason for why we did each of these things. You see, it all comes down to your view of at what price the SPY is a screaming bargain and at what price you think the SPY is fully priced and doesn't have much additional upside. Well, think about it. Remember, you bought those 400 shares of SPY a few weeks earlier for 420. And so let's say that you're willing to sell those for 490, which after all is above SPY's all-time high by 10 points and would constitute a profit of $28,000. Well, if SPY closes above 490 on the day they expire, then the owner of those calls is going to exercise them and buy the shares below market, which is his right because he paid for that right. And so that's why you sold those 4 calls. And similarly, you're more than happy to buy 400 more shares of SPY if they were to reach 360 or lower by expiration, which is almost exactly a 25% discount from SPY's all-time highs. And so that's why you sold those 4 puts. And finally, the 4 long puts down at 260, you bought those to control the amount of capital that your broker will require for you to put this trade on, which we can explain in depth in another video. But for now, please accept that by doing so, you would cut down your capital requirement to put this trade on substantially. So what this means is that if regardless of the VIX level, you'd be willing to follow this trade plan, selling at 490 and buying at 360, then you're far better off implementing this game plan in a high volatility environment than a low one. Remember, we received a little bit over $6,000 for the low volatility trade in 2021, and that increased to over $10,000 in the high volatility time. The exact same trade, just one benefiting way more from options pricing than the other, which in this case provides a price improvement of over 65% just for being selective as to when you implement this trade, seizing decisively on the opportunity to get that far superior pricing pretty much just by paying attention to where the VIX is. And one more thing I'd like you to think about before we wrap up, and that's the scenario where SPY closes between 360 and 490 on the day the options expire in 2023. Well, in that case, the puts you sold down at 360, they expire worthless, and the 490 calls you sold also expire worthless, meaning you just pocket the $10,000 you collected for entering into this trade. That's not bad. And so what I'd like you to take away from today's video is the pretty stunning power of selling options when they are pumped up by fear. In this case, the difference between the 16 VIX and the 35 VIX levels resulted in a 65% improvement for the exact same trade. That's nothing to sneeze at, and professional traders don't. We make money by picking up on these kinds of market situations, and now you have some insight as to how to do that yourself. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.